Come in to talk macro markets, and thanks, Julian. Just come straight out of your hour-long session with the actions to us clients doing a Q&A and the amazing, great session. I listened to about the last 45 minutes of that. I thought it was brilliant, mate. Thank you for that. What are you going to ask about markets today?
Well, first off, leave that chart up. So the reason why I want to leave that chart up is this, finally, the break in the Canadian dollar that we've been looking for. Paul, go back on that chart a little bit further, right?
So you could actually pull that range down to there, couldn't you, and suggest that we're out of the most recent range.
Absolutely.
Top there. We actually do have a breakdown. Now, there are these areas here. I'm going to go back because I've just got to get, Zoom, Julian. I've just got to get some images of people out of the way. Just go away there. And I'll go back and I just bring some more data in for you. How much data would you like?
Just keep going back till the Australian dollar actually doesn't go down.
Dollar CAD, you mean?
Sorry, dollar CAD, doesn't go down, right? So you just keep going with this, right?
Look, it's one of the dollar CAD is just a brilliant trend trading pair, isn't it? This has been, honestly, I don't know how I did that or how to undo it, but I'll see if I can undo it for you now. That was, I do many things on MT4 I don't know how to undo. There we go. So
that's good enough, Paul. Guys, look at that crazy chart, right? And I think what's really interesting about this is there's been a few fits and starts on the Canadian dollar. I always had in my head that was going to get down to about 118. On the monthly chart, there's a major support, I believe, down at about 118. But maybe we're not going to make it. Two things are going to happen here, right? As always, I love it when markets break out because there's only two possible outcomes from here. Yeah, there, right? There's only two possible outcomes from this, right? Is that it reverses and goes back up again, and everybody will scream and kick their whole way as this market trades up to whatever resistance point, and there's about 42 million of them on the way back up, right? You just choose your poison, okay? So, and the second thing is, if this fails, if it goes up for a couple of days and it turns around and fails, that's information that we need to have as well too, because then it makes trading easy. Because if it fails, it's probably going to go down to a new low, in which case life is easy and straightforward, right? So the great thing is, and what I love about trading some days, is you get into this nice little simple binary pattern. There's very few things that are going to alter that binary pattern from here. So I expect the Canadian dollar, I love, and I think it would be just interesting and fascinating for it to do something other than nothing, as it has done for the past 2 or 3 or 4 or 5 weeks, whatever it is, right? For this thing to start moving upwards. Why would that be interesting? Well, it would confuse everybody, because just about the entire world is bearish of the US dollar right now. But also, it's also a maybe sign that people are thinking about taking profits on their oil and gold positions, which have been, I think, the basis for some of the Canadian dollar strength that we've seen over recent weeks as well too, because it is, after all, treated as being a commodity dollar currency. So if the commodity market rises, then you often see the Canadian dollar strengthening, and therefore dollar CAD will then go down. So let's see what happens, because we don't know. I do know that I'm awful at predicting the future, but I'm not so bad at capturing it as it's starting to unfold. So what we're hoping here is that this gives us a bit more traction. For the record, I do have a long position in this, so I have, if you like, bought this breakout, and we'll see what happens. There's other reasons why I have bought this breakout I'd rather not get into, but let's just call it a momentum divergence would be a good starting point, right? So that's slightly off topic, because I really wanted to talk about macro markets. Two things I want to mention here. Number one, we had a absolutely ridiculous US CPI figure on Thursday, 5%. I believe it's the first time since 1992, which for most people is possibly beyond the point where they were born. And if you can remember 1992 like I can, you know it was some distance away. Black and white television, no internet. There was something called books, stuff like that, right? So some time ago, right? The key thing about this is the Fed has said all the time that this is transitory, right? All the time, over and over again. Don't worry, guys, it's only just transitory. So what did the bond market do? Because for me, the US Treasury bond market is the ultimate arbiter of what is going on. There's a reason for this. Okay, so sidebar here. To become a bond trader, you have to be good at maths. Okay, that's one of the key requisites for bond traders. Well, at least competent at maths, because I'm not brilliant at maths and I was a bond trader. But you need to understand what is going on. When you understand bonds, you understand the world. right? Stock traders just need to be really good at reading psychology, because you just buy something that goes up. And equities sit at the very taily end bit of the company debt structure, the company capital structure, right? Bonds form the vast bulk of it, and so bonds are far more important to company cash flows than anything else, right? Anyway, sidebar, right? However, right, why is this important? Well, the bond market on Friday, the 10-year yield traded a low at one point during the day of 1.42. If you look at the bond market for the past 3 months, you will see it's one of the best trading markets in terms of performance out there. It has done nothing but rally. Do you remember 3 months ago in March, we were calling an end to the world for bonds? Interest rates were going up. They were never coming down. Inflation's picking up. End of the world, Armageddon, yada, 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 yada. What has happened since then? Well, what has happened since that point in time in March is bonds have rallied. In price terms, okay, in price terms on the 10-year note, not a huge amount, only about 3 or 4 points. So it's about 3%, so not brilliant. In yield terms, they have fallen from 177 to 142. That's an awful lot if you're a bond trader, right? That is not the stuff of a bear market. That is the stuff of a bull market, right? So why then did yields fall, and are they lower than where the market was when we had the inflation print last month at 4 point something that everybody freaked out about then? Okay, so this is my moment here, right? When we think about this, right, we go, oh, maybe the bond market's right. And if the bond market's right, now I get that this could be an intermediate top, and I get all of that, and maybe yields are going to drift higher from here, right? Get all of that stuff, okay? But why, on the very day when we had that CPI number come out, did the bond market rally? It rallied because it doesn't believe the CPI number is anything other than a very short-term measure, and what it's more worried about is what's going to happen next. Okay, so fast forward 4 or 5 months, okay? For those of you who don't know, there's a seasonal pattern in the bond market, okay? Bonds tend to fall in price, rise in yield in the first 6 months of the year in the US. We could argue the toss about when that starts and when that ends, but call it roughly the first 6 months. Why do they do that? Well, they do that because most of the time the government raises all their prices in the first 6 months of the year. So, okay. What happens because they're doing it as they come to the end of their financial year in anticipation of the new financial year, right? So, what do we know about the second 6 months of the year? Well, the second 6 months of the year historically is when inflation falls. Okay, so the rate of inflation falls, not inflation itself falls. It could do, but the rate of inflation tends to drift away to the downside, right? It's called a tendency to go lower. Okay, so what does that mean? Well, during that time, if inflation is falling or not rising as fast, then very clearly the bond market will respond positively to that news. So again, you could argue over the first 6 months of the year, bond prices fall. Over the second 6 months of the year, bond prices have a habit of going up. Okay, so fast forward to today. Where are we now? We're about the end of that 6 month block, and bond prices have been rising for a couple of months. But over the first 6 months of the year, this has been a nightmare 6 months for bonds, right? The 10-year note started at a price of about 136, fell to a price of about 130, which, by the way, in bond land is a massive move, right? And has then rallied back to about 133 again. So it's still well down on the start of the first 6 months. From here, what do we expect? Well, if our theory holds true, there is a seasonal bias of bond prices to rise for the next 6 months. So try and take those buy signals when they turn up. But this really gets down to the crux of this. So if the bond market is probably going to either remain where it is or do better over the course of the next 6 months, what is that saying about that rate of inflation? Two things, right? Number one, oh my God, that's a negative yield, right? A negative real yield of 3.5%. That is crazy, right? So in other words, you are losing 3.5% every time you buy a 10-year US Treasury bond at this inflation rate, right? So that means that your savings are going to be 3.5% less, worth less at the end of the year than they are at the beginning. Ouch, right? Way around it, think about inflation-linked securities, but let's move on from that, come back to that another day. Or the inflation rate is utterly and completely rubbish. And it's not rubbish because we know it's happening out there. We all know that. But what the bond market is telling you is it doesn't matter. It really is just transitory and it's going to go down. And more importantly than that, it's more than transitory. Inflation's still a big problem, right? Roll back to in the past, when you go look at a bond chart, you will see when there have been previous inflation spikes of 2.5% or 3%, the bond market yields were 2.5% or 3%, not this crazy negative real yield we see today. So my thoughts on the macro side today are massive new high in CPI. The bond market not only completely ignored it, they smiled in the face of inflation and went, no, I think you're totally barking up the wrong tree. Now, is that going to unfold across the rest of the G7 or G8? Well, I think probably if inflation is topping out in the US, it's going to top out everywhere else. And if that is the case, then we have a bigger problem to think about. And if that is the case, then I suspect that could well be US dollar bullish from a fundamental point of view. Because if the economy starts to slow in the US, then I think the economy will start to struggle everywhere, in which case that's going to need more government spending, but it won't come from the US because the US, I think and I believe, has done enough so far. It's got to come from everybody else. They're going to unbelievably have to spend more, crazy though it seems, right? So lots to think about there. Let's just deal with where we're at the moment. The bond market is literally laughing in the face of inflation. And I'll leave you with that, Paul.
Yeah, I took a moment to come back in. Cheers for that, Julian. Interesting stuff. Thank you very much for that. Always good to get the macro market overview and have a look at this market. And look at one thing we know, if it's going to be as sideways as it has been, that at some stage it's